Hello, dear friends, Max Cash is in touch. Before starting the video, I want to invite you to my Telegram channel with signals and automatic trading of copies. The link to my Telegram is under this video. The market price tends to the levels, and this is understandable, because it is at the levels that the accumulation of market orders is located. Therefore, there are several techniques for predicting these levels, from simple N to the extremely popular Fibonacci numbers, which are found on literally every third chart. There are a huge number of trading systems based on them, however, all of them can be divided into two topics: corrections, retracements, and extensions. The sequence starts with 0, then 1, then 0 plus 1 equals 1, the third number. The second and third numbers of the sequence, 1 plus 1 equals 2, are added to it, and the fourth number, a third, is added to it and it's gone. The Fibonacci sequence is the sum of the two previous numbers. Then, based on these two numbers, a curious proportion is determined. If the first number in the sequence is divided by the second, then the next number in the row will be equal to 0.618. For example, if 55 is divided by 89 or 21 by 34, it's always the same proportion, rounded up. It is always 0.618. If you divide the numbers by 1, you will always get 0.382. Let's say 1334 or 3489 equals 0.382. The magic of numbers. These fractions are considered the so-called golden ratio and are found everywhere in nature. They especially like to show spirals as an example of how sunflower seeds are stacked and so on. A kind of universal fraction. Let's agree right away, Fibonacci levels are a trending tool, they are not suitable for consolidation. The bottom line is that when the trend goes up, the price tends to pull back from resistance levels based on Fibonacci fractions. The same is true for the downtrend and support. To build these levels, we will need swings in a grid on a live graph. We found the lower swings, then the upper ones, and stretched the grid between them. An urgent trend reversal, and the 0.500 level was not a decree for him. What conclusions can be drawn from this? Fibonacci retracement levels, like everything in technical analysis, require careful elaboration and continuous refinement, constant filtering. All technical analysis is based on probabilities, not guarantees. Therefore, the price does not always interact with these levels the way you want it to. Sometimes the levels break through, sometimes instead of 0.500, a rebound occurs from 0.618 and a lot of other examples. Sometimes the price of those levels is deep to the light bulb. The price, as such, moves from one level to another, and some levels are more significant for it at a certain point in time, and some are less so. So when using Fibonacci levels, you will need all the tools in your arsenal that we already know about. The tools we use to filter inputs from support and resistance levels, it doesn't matter if it's Fibonacci or regular. For example, oscillators with their divergences, price action patterns, and more. And anyway, let's combine Fibonacci levels with support and resistance, it's a good idea. Another way to use Fibonacci is together with another basic technical analysis tool. And what kind of instrument do we have after support and resistance? That's right, trend lines. It is in the uptrend and downtrend that many traders use Fibonacci retracement levels, so combining them with trend lines is what the doctor ordered. In the next video, I'll show you on the chart in more detail how to draw Fibonacci levels and how to make trades from these levels. Wait for the next video, it will be released on the channel soon. I am also waiting for everyone in my Telegram channel, the link below this video.